In 2021, Florida's condo market was a gold rush. 220,000 newcomers packed the state. Miami-Dade's supply vanished, and bidding wars raged late into the night. But by 2025, headlines read, "Governor loses it," as South Florida's condo dream became a financial nightmare. The collapse wasn't a single spark, but a chain reaction. Crushing assessments, insurance giants pulling out, and mortgage approvals evaporating, leaving owners trapped, and the governor pointing fingers in a public outburst. With billions in home equity and Floridians' futures now in freefall, how did a sun-soaked boom turn into one of Florida's worst housing meltdowns? The answer begins with the migration wave that set catastrophe in motion. By the spring of 2021, Florida's welcome mat stretched from the Panhandle to the Keys. Newcomers arrived in waves, some chasing remote work, others fleeing high taxes or cold winters up north. Census data counted more than 220,000 fresh arrivals statewide that year, with Palm Beach County alone swelling by over 16,000 residents. Miami-Dade and Broward, always magnets for international buyers and retirees, saw their populations climb as well, fueled by buyers from New York, California, and Latin America. For every family unloading a moving van in Boca Raton, another investor closed on a pre-construction condo in Brickell. Demographic analysts tracked the surge using everything from utility hookups to USPS change of address forms. The numbers told the story of relentless demand. Florida ranked first in net domestic migration for the second year running, outpacing Texas, Arizona, and the Carolinas. U-Haul shortages and jammed highways became routine. In some neighborhoods, local schools added portable classrooms just to keep up. This wasn't just a trickle of retirees. Young professionals, remote tech workers, and families with children all contributed to the population boom. Even as pandemic restrictions faded elsewhere, Florida's open for business stance drew headlines and more arrivals. Some cities, like Port St. Lucie in Cape Coral, saw their fastest growth in decades. While Miami's skyline filled with construction cranes trying to catch up, inventory couldn't keep pace. By late 2021, active listings for condos in Miami-Dade, Broward, and Palm Beach fell to their lowest point in over 15 years. Realtors fielded dozens of offers on a single unit. In Delray Beach, a two-bedroom condo could attract 10 buyers in a weekend, most with cash in hand. The state's population topped 22 million for the first time on record. Demographers warned that such rapid growth would strain housing supply and infrastructure. But for the moment, demand seemed insatiable. Every new resident needed a place to live, and every empty unit became a battleground, setting the stage for a condo market where scarcity would soon give way to something nobody expected. On a muggy Saturday in July, Broward realtor Angela Torres unlocked the door to a modest two-bedroom condo priced just under $300,000. She barely had time to prop open the blinds before the first buyers arrived. 3 couples, all with pre-approvals in hand, 2 waving cash offers. By noon, the parking lot was packed. One family from New Jersey toured the unit for less than 5 minutes, then offered $20,000 over asking, sight unseen by their out-of-state parents. Another couple, local teachers, tried to match the bid but lost out when a Miami investor wired a deposit before lunch. Angela's phone buzzed with texts from agents, begging to squeeze in a showing. By 3 p.m., the condo was under contract, the seller fielding backup offers just in case the first deal fell through. Stories like this played out across South Florida in 2021. In Hallandale Beach, a 1970s-era building listed a one-bedroom at $289,000. The listing went live at 9 a.m. By 2 p.m., it had 16 offers, 10 in cash, several from buyers who hadn't set foot in Florida. In West Palm, agents joked that open houses needed velvet ropes. Some buyers submitted letters, family photos, even homemade cookies, hoping to sway sellers in their favor. But charm rarely beat cash. Units under $300,000 barely lasted a day. Bidding wars became the norm, not the exception. Realtors remember one weekend where she wrote 5 offers for the same client, each time losing to out-of-state buyers who could close in a week, no contingencies. It wasn't about who wanted it most, she said. It was about who could move the fastest and pay the most, no questions asked. For every unit sold, a dozen hopefuls left empty-handed. Buyers camped outside leasing offices, scanned new listings at midnight, and called in favors with mortgage brokers. The scramble wasn't limited to the coast. Inland cities like Sunrise and Tamarack saw condos snapped up within hours, sometimes above appraised value. The market's heat was relentless. Realtors compared it to a lottery, except the odds seemed to get worse every week. Scarcity and urgency fed on each other, driving prices higher and buyers to the edge. Behind every closed sale was a crowd of frustrated would-be owners watching affordability slip further out of reach. The Surfside tragedy, in June 2021, forced Florida's lawmakers to confront the cracks, literal and financial, running through thousands of aging condo buildings. Within a year, the legislature drafted Senate Bill 4D, a sweeping law that rewrote the rules for high-rise living across the state. The new mandate? Every condo building above 3 stories must undergo a structural milestone inspection by age 30, and again every 10 years after that. For Miami-Dade and Broward, the clock ticked even faster. First inspections due by the end of 2024, regardless of building age. Engineers were suddenly in high demand, poring over concrete, steel, and rebar, searching for signs of corrosion or instability. Boards received thick inspection reports, many flagged with urgent repairs and looming deadlines. But the law didn't stop at inspections. Senate Bill 4D required condo associations to build up reserve funds. No more waiving or underfunding accounts meant for major repairs. For decades, many buildings operated with minimal reserves, keeping monthly fees low and deferring costly fixes. Now, each association had to commission a reserve study and start collecting enough from owners to cover future needs. The median special assessment landed at $45,000 per unit, with some buildings demanding 6-figure lump sums. Owners who bought expecting stable fees found themselves facing bills that rivaled a year's salary. In Fort Lauderdale, the board at Sunrise Towers called an emergency meeting after their inspection uncovered spalling concrete and water intrusion on multiple floors. The required repairs topped $6 million. The board, made up of retirees and working professionals, debated how to break the news to residents. The options were stark: pay up, sell at a loss, or risk the building falling out of compliance and losing insurance altogether. One board member described the mood as grim, like telling your neighbors they've won the world's worst lottery. State lawmakers defended the reforms, pointing to Surfside as a warning that deferred maintenance could end in disaster. Public hearings included testimony from engineers, insurance executives, and grieving families, all arguing that safety could no longer be optional. Still, the economic shock was immediate. Realtors reported deals falling apart mid-closing, as buyers balked at disclosure packets detailing upcoming assessments. Some associations struggled to find qualified inspectors or complete studies by the deadline, risking fines and legal action. The new rules tied safety and solvency together in ways the market hadn't seen before. For every building that passed inspection and funded reserves, there were others staring down repairs they couldn't afford. The intent was clear: prevent another Surfside. But as the costs filtered down to owners, the next wave of the crisis, financial, not structural, was already building. In the aftermath of new inspection laws and reserve mandates, the real cost landed squarely on the shoulders of everyday condo owners. Monthly HOA dues, once a manageable line item, ballooned almost overnight. By mid-2025, the average fee for a two-bedroom in Broward or Palm Beach topped $1,250, up more than 50% from just 3 years earlier. In some older buildings, owners faced not only higher dues, but also special assessments that rivaled a year's income. Letters from association boards arrived in quick succession, each more urgent than the last. Some demanded $45,000 or more per unit to cover emergency repairs and replenish depleted reserves. For retirees on fixed incomes, the news hit like a thunderclap. At Seabreeze Residences, a 1970s-era building in Miami, the board convened an emergency meeting in August 2025. The proposal on the table, a 300% hike in monthly fees. The room filled with anxious voices. Residents who had planned to age in place now facing bills they could not pay. Tears mixed with shouts as one owner, a retired schoolteacher, clutched her notice and whispered, "This will bankrupt us." Several neighbors walked out, already calculating how much they'd lose if forced to sell into a falling market. Stories like these echoed across South Florida. In Fort Lauderdale, a widow who bought her condo for $180,000 in 2016 watched her monthly obligation climb from $600 to nearly $1,700. Her pension barely kept pace, and the threat of another special assessment lingered with every board update. In West Palm, a couple in their 70s drained their savings to cover a $52,000 assessment, only to learn their HOA planned another increase to meet insurance shortfalls. Analysts from the Federal Reserve Bank of Atlanta warned that these costs weren't just a blip, they had become the new normal. Owners who once counted on stable expenses now faced a moving target, with fees and assessments rising faster than Social Security or investment returns. Economists called it an affordability crisis, but for many it was simply a question of survival. As the burden mounted, investors began to pull back. Even those with deep pockets hesitated at the prospect of runaway fees and unpredictable liabilities. Meanwhile, first-time buyers and families on moderate incomes found themselves priced out before they could even make an offer. The practical result? A market full of listings, but fewer and fewer people able or willing to shoulder the risk. The emotional toll showed up in boardrooms, hallways, and kitchen tables, where owners weighed impossible choices between staying put, selling at a loss, or risking foreclosure. The spiral had begun, and the next blow, insurance, was just around the corner. Six insurance carriers failed or withdrew from Florida between 2022 and 2025. Each departure announced with barely a warning. United Property and Casualty, once a mainstay for coastal condos, cut more than 30,000 policies in August 2025 alone, just as hurricane season reached its peak. That exit left entire buildings scrambling, some forced to accept bare-bones coverage with double the premiums, others unable to find any private insurer at all. By the time the dust settled, more than 600,000 homeowners statewide had lost their private coverage in less than 3 years. Industry filings with the Florida Office of Insurance Regulation tell the story in black and white. Escalating reinsurance costs, mounting litigation, and catastrophic exposure made the business unworkable for mid-sized carriers. United, St. John's, FedNat, and others cited unsustainable loss ratios and regulatory uncertainty in their withdrawal notices. For South Florida, the impact was immediate. Buildings that had renewed policies for decades suddenly found themselves blacklisted by every major underwriter. Analysts from the Federal Reserve Bank of Atlanta and insurance market experts warned that the risk had shifted overnight from insurers to individual owners and their associations. Without private coverage, boards faced impossible choices.
Pay triple for a specialty policy, risk going uninsured, or force a special assessment on already strained residents. Lenders began to reject mortgages on units and buildings without compliant insurance, freezing deals mid-escrow and leaving sellers with no way out. The insurance exodus didn't just raise premiums, it introduced a new uncertainty. Would a building even qualify for coverage next year? Or would the next hurricane forecast send another carrier running? For thousands of condo owners, the answer came in the form of cancellation letters and a market suddenly short on options, but long on risk. The scramble for coverage was only beginning, and the financial burden was about to get heavier for everyone left behind. Citizens Property Insurance, Florida's state-run safety net, became the last option for thousands of condo owners when private carriers pulled out. By the end of summer 2025, Citizens counted more than 1.1 million active policies, double its book just 18 months earlier. The company's growth wasn't a sign of confidence. It was a symptom of a market running out of choices. In South Florida, entire buildings landed on Citizens rolls after receiving non-renewal notices from every private insurer willing to write coastal risk. Boards scrambled to secure even basic coverage, often settling for stripped-down policies with double deductibles and limited protection. For buyers, the consequences hit at the closing table. Major lenders, Wells Fargo, Chase, United Wholesale, issued new bulletins in 2025. Loans on condos insured only by Citizens would face extra scrutiny, higher down payments, and in many cases, outright rejection. Fannie Mae and Freddie Mac, the backbone of the mortgage market, required proof of supplemental coverage for wind, flood, and full replacement cost. If a building's Citizens policy left any gap, the loan was ineligible for purchase. Deals unraveled mid-escrow as underwriters flagged associations with incomplete or insufficient insurance. Some buyers lost deposits. Others watched interest rates climb as their only option became a riskier portfolio loan. Loan officers across Miami-Dade and Broward counties described a new routine, explaining to frustrated clients that even pre-approvals meant little if the building's insurance didn't pass muster. One veteran broker in Fort Lauderdale said, "It's not about your credit score anymore. It's about your building's insurance binder." In buildings with recent structural assessments or deferred maintenance, the list of willing lenders shrank to almost none. Cash buyers gained the upper hand, but even they hesitate if the association's coverage looked shaky or the next premium hike loomed. The result was a market where listings lingered, not for lack of interest, but because financing had become a minefield. Owners desperate to sell found themselves boxed in by insurance paperwork and lender refusals. For first-time buyers and families, the dream of a South Florida condo faded behind a wall of red tape and rising costs. The safety net stretched thin, now threatened to snap, leaving buyers and sellers alike searching for a way out. Mortgage math in South Florida has turned punishing. By the middle of 2025, the median monthly cost to own a condo, principal, interest, HOA dues, insurance, and assessments, easily tops $2,100. For thousands of buyers, the sticker shock doesn't end at the sale price. HOA fees alone can swallow half a paycheck. Special assessments, once rare, now arrive with regularity, sometimes tacking on hundreds or even thousands more each month. Owners who budgeted for a $1,400 payment in 2021 now find themselves shelling out nearly double with little warning and no recourse.
The numbers are relentless. In Broward and Palm Beach, it's common to see monthly obligations for a modest two-bedroom climb from $900 to $1,700 in just 3 years. In older buildings, the burden is even heavier, as reserve requirements and insurance hikes stack onto stretched budgets. One West Palm Beach resident who bought her unit for $180,000 in 2016 now pays almost $1,700 a month, nearly triple her original payment. Her story is no outlier. Across the region, retirees on fixed incomes, teachers, and young families all struggle to keep pace with bills that outstripped their wages and savings.
The pain is not just anecdotal. The Federal Reserve Bank of Atlanta's mid-2025 report confirms that median condo payments in South Florida have crossed the $2,100 threshold. Even as prices for many units have fallen, the culprit? Runaway non-mortgage costs. Insurance premiums have doubled, sometimes tripled. Board-imposed reserve contributions and emergency repairs push monthly dues to record highs. For buyers relying on FHA loans, the situation is even grimmer. FHA condo approvals have dropped by roughly 40% since last year, as more buildings fail to meet updated reserve and inspection standards. That means fewer affordable financing options and more rejections at the closing table. The fallout lands hardest on working families and first-time buyers. Mortgage application volume for Florida condos has plummeted, down nearly 35% year-over-year. Lenders wary of ballooning monthly obligations and shaky association finances demand higher down payments and pristine credit. The result? A market where the cost to carry a condo has become a barrier few can clear, even as prices slide and listings pile up. For many, the dream of homeownership in South Florida has given way to a monthly bill they can't escape and fewer ways to manage it. By the summer of 2025, the rules for borrowing in South Florida had changed almost overnight. Loan officers, once flooded with eager applicants, now spent their days explaining why pre-approvals no longer guaranteed a closing. The banks weren't just looking at credit scores or pay stubs anymore. Every file was dissected for risk. The building's insurance binder, reserve study, and even pending special assessments. If a condo association relied on Citizens property insurance alone, lenders demanded 30% down, sometimes more, or declined the loan outright. Fannie Mae and Freddie Mac, the giants behind most mortgages, required airtight proof of full replacement coverage and strict compliance with new reserve rules. Any gap, any missing document, and the loan was dead on arrival. Interest rates above 7% became the new normal, with many buyers offered even higher quotes if their building showed any sign of financial stress. A two-bedroom unit that might have required $60,000 down in 2022 now demanded $100,000 or more just to start the process. For first-timers and middle-class families, the math didn't work. Mortgage application volume for condos in Florida dropped 35% year-over-year. Some lenders quietly pulled out of the market altogether, citing too much volatility and too little reward. Loan officers in Miami-Dade and Broward described a shift from rubber stamping to redlining. One veteran broker said, "We used to compete for buyers. Now we compete to avoid risk." Underwriting teams flagged buildings with unfunded reserves, deferred maintenance, or recent insurance claims. Even buyers with perfect credit found themselves sidelined by stricter debt-to-income ratios and new documentation hurdles. The result was a shrinking pool of qualified borrowers and a growing pile of unsold listings. Cash buyers and investors picked through the remains, but even they hesitated when faced with runaway fees and looming assessments. For everyone else, the message was clear. Unless you could put 20% down, clear every hurdle, and absorb a payment north of $2,100 a month, the door to South Florida's condo market was closing fast. The tightening grip of lenders and underwriters wasn't just slowing sales, it was freezing hope for a new generation of homeowners.
Deltona, once a quiet waypoint between Orlando and Daytona Beach, became the epicenter of Florida's condo crash by the summer of 2025. The numbers are blunt. Median condo prices in Deltona dropped more than 32% year-over-year, wiping out hundreds of millions in homeowner equity in less than 12 months. Units that fetched $250,000 in early 2022 now struggle to attract offers above $150,000. The local MLS shows a 14-month supply of condos on the market, 5 months above what brokers call a balanced market, and a clear signal that sellers outnumber buyers by a wide margin. For longtime residents, the collapse is more than a spreadsheet. In the Oak Ridge Villas complex, a group of owners gathered signatures for a petition demanding relief from city officials after monthly HOA dues doubled and special assessments landed like a second mortgage. Some retirees, blindsided by five-figure repair bills, now spend their mornings calling foreclosure hotlines or meeting with bankruptcy attorneys. The community Facebook page, once filled with block party invites, is now a running tally of units in default and neighbors forced to walk away. Foreclosure filings in Volusia County have jumped 41% since January, with Deltona accounting for the largest share. Local legal aid clinics report a surge in calls from condo owners, teachers, nurses, small business owners who no longer can keep up with ballooning fees and plummeting home values. Real estate analysts warn that the city's inventory glut is unlikely to clear soon. With every month that units linger unsold, prices sink further, pulling more owners underwater and tempting investors to circle for bargain buys. The ripple effects stretch well beyond city limits. Lenders in North Carolina and Texas are now scrutinizing condo associations for reserve funding and insurance coverage, wary of importing Florida's crisis. State housing officials in Arizona have cited Deltona's woes in committee hearings, using its 32% price drop as a cautionary tale for their own aging condo stock. For Deltona's homeowners, though, the pain is immediate and personal. A daily reckoning with bills they can't pay, equity they've lost, and a market that no longer offers an easy exit. The ground zero of Florida's condo collapse isn't a beachfront tower or luxury high-rise. It's a middle-class city where the promise of stable home ownership has given way to a slow-motion financial emergency. June 2025. Cameras crowd the dais at the Roberto Alonzo Community Center in Miami Lakes, where the governor steps to the microphone, tie askew, jaw set. The room hums with tension, reporters clutching foreclosure statistics, homeowners waving HOA bills, a row of staffers exchanging clipped texts. The governor's voice cuts through the noise. This is not a drill. Florida families are being squeezed out of their homes, and I will not stand by while insurers and lenders pull the rug from under them. He points to the latest wave of insurer exits. United Property, St. John's, FedNat, all gone in less than 3 years, leaving more than 600,000 homeowners statewide without private coverage. The governor's tone grows sharper. Let me be clear. If you're an insurance company that wants to take Floridians' money for years, then vanish when the market gets tough, you're not welcome here. We are done playing by your rules. He slams a stack of foreclosure notices on the podium. The numbers are ugly. Deltona's median condo price down 32%, a 41% jump in foreclosure filings across Volusia County, and HOA dues that now rival a second mortgage. We have retirees getting eviction notices because of insurance games and runaway assessments, he says, voice rising. Working families are being told their dream of home ownership is over because Wall Street and out-of-state carriers can't stomach a little risk. That's not the Florida I represent.
Questions fly from the press gallery about failed reforms, about citizens' property insurance's ballooning policy count, about the exodus of private insurers. The governor's frustration is palpable. Citizens was never meant to be the only option for 1 million Florida homes. We're supposed to have a functioning market, not a single safety net stretched to breaking. He calls out the blame game between lenders, insurers, and condo boards, warning that finger-pointing won't solve the crisis. We need real solutions now, not next year, not after another special session. If the legislature can't deliver, I will use every executive power at my disposal to protect Floridians. A pause, then a direct challenge. To the insurance executives watching, if you're planning more cancellations, you'd better be ready to explain it to every family losing their home. And to the lenders, don't think you can hide behind paperwork while communities fall apart. The press conference ends with a final clipped promise. We will not allow Florida's condo market to collapse on the backs of its people. Not on my watch. The headlines write themselves. The governor's anger, raw, unscripted, lands like a thunderclap across the state, capturing the desperation of owners, the anxiety of buyers, and the political peril of a crisis with no easy fix. In 2025, Deltona's condo prices dropped by 32%, and unsold inventory reached a 14-month supply, the steepest decline recorded in Florida's recent history. The story began with a migration wave that pushed demand and prices to all-time highs. But soon, stricter safety laws, soaring association fees, and the exit of 6 major insurance carriers triggered a cascade of financial strain. By mid-2025, Citizens Property Insurance was carrying over 1.1 million policies, while FHA condo loan approvals fell 40%, and mortgage applications dropped by 35%. Despite public statements and emergency meetings, many questions remain. Will further regulatory changes restore buyer confidence? Can insurance access and affordability be rebuilt? As of today, thousands of owners and buyers face rising costs and uncertain options. The collapse of the South Florida condo market stands as a documented warning, clear evidence that financial, regulatory, and political pressures can converge to reshape entire communities, with effects still unfolding.